Meta Platforms Inc., ticker symbol Meta, formerly known as Facebook, is currently trading at $521.31 a share. Over the last year, this stock has massively increased its value, up 75%, beating Microsoft, Amazon, and Apple, who are up only 20% in that similar time. What we're going to be doing is looking at the stock price, comparing it to the market, and then we're going to be going to my automated stock valuation spreadsheet to see if Meta is a buy or a sell using the discounted free cash flow model, the comparable company model, the dividend discount model, as Meta do pay a very small dividend, and the Ben Graham formula for intrinsic value. So as I said, let's have a quick look at the stock price. Over the last year, it is up massively, and we'll take this chart a little bit further out. This stock was trading $376, had a massive 70% downswing down to $90 a share, and has now up 447% since that time. If we were to compare to the S&P 500 over the last 5 years, even with that massive downswing, obviously it has increased since then, it is up almost 180%, easily beating out the market. Over the last year, similar story as well, 75% to 25%, and year to date up 50% compared to the market's meager 20%. Right guys, let's have a look at my automated stock valuation spreadsheet. What you do is you will type in the ticker, which in this case is Meta. It will load all of the latest company financial data, and then we'll have a deeper dive. So as I said, market cap of 1.3 billion, price of 100. If it was 100, I would definitely buy it. $521 a share. P ratio of 26. So actually that is quite interesting because it is slightly lower than the market average. So that is looking a good sign. Earnings per share about $20 per share. Beta of 1.21, which means it's slightly more volatile than the market. And analysts say it's currently sort of a hold, maybe even a sell. Target price of $508 a share. So that's interesting to see. Dividend, they do now pay a dividend 0.38%, which nets you around about $2 per share. 4.3 billion dividend, and because of because of Meta's massive free cash flow, it is very, very safe. So we'll have a look at the revenue. It has exponentially grown basically every single year. It was down in 2022 when the stock price took a bit of a tank, but up to all-time highs of 150 billion or 149.14 billion. Net income, are they profitable? Yes, they are. Well, massive profit margins if we were to compare there. But basically, you can see the profit has consistently grown. They were down in 2022, but now all-time highs of 51.49 billion. Free cash flow, I'm going to expect something similar. They have almost 50 billion in free cash flow in the trailing 12 months. That is crazy to see. They did have that down blip, and they've managed to go from strength to strength, and also it is growing exponentially, but also pretty in line with what we've been seeing over time. Shares outstanding, what are they doing with their shares? Over the last few years, they actually have been doing a massive buyback, so they're rewarding shareholders who currently own their stock. And if we look at, let me just go here and go to the last 5 years. From buying back from 2022 up until 2024 was a great decision, as the stock was much lower than it is right now. Now let's have a look at, also assets versus liabilities. Assets and liabilities have, previously assets were very high, but they did take on some debt, but you can see here, still higher. Right, now let's have a look at the discount free cash flow model. This is a way of valuing a company using its expected future cash flows. It determines the value of today based on projections of how much money it will generate in the future. So straight away, these is looking at averages, and you can see it is not a buy. It's $310 a share. Let's have a deeper dive into the numbers and see what we think. So revenue growth rate, we're at about 10%. Analysts, if we were to look at what analysts say in terms of the growth over the next 5 years per annum, they're expecting around about 13.6%, with revenues in the region of 160 and 183 billion. So let's go. I'm completely forgotten the number I just said there. It was 13% over the per annum over the next 5 years. So we'll go with 13.6%. A bit more in the bullish case, yeah. Slightly higher revenue estimates there. Still $352 stock. Net income margins, we'll take an average of the more recent years. In fact, actually what we'll do is we'll take an average of all these apart from 2022, which is 2.7%. That probably brings it to around about a $400 stock. And free cash flow net income, I'm going to go with 100% here because of the more recent numbers. So interestingly, not a buy on discount free cash flow model. It's about a $470 stock, which is quite interesting. Obviously says it isn't a buy right now, but on these big tech super growth companies, it's interesting to say the discount free cash flow model is not a million miles away on the price. Free cash flow ratios of 33 currently. Next, we'll have a look at the comparable company model. This is a way of valuing companies looking at similar sizes. Oh, actually, I've already got them here. So what we can do, the metrics that we're looking at, EV to revenue, EV to EBITDA, and PE, but then we also look at revenue, 5-year growth rate, profit margins, price to sales, price to book, and PEG. So I've already actually included these. Normally I would show you how cool this is, but I've included these because these are similar stocks. So what we'll do is we'll also type in Microsoft, and you can see it loads the latest company financial data. If you're interested, please check out my Patreon. Links are in the description. What I've done here is I've actually added the price. So you can see over the last 225 days, all these stocks are up. I'll add some extra information here, but it's kind of just a quick glance. Obviously, companies like Apple, Microsoft, and Google are on the up at the minute. So it's just going to show green. Maybe I'll show the price start of this time frame, and at the end, if we were to look over the last 30 days, for example, it'll reload it, and you can see that Meta and Apple are up, whereas Microsoft and Google are down. So enterprise value, all over the place. Meta is the smallest of the three companies, interestingly enough, 1.2 trillion compared to 3 and 2 trillion. Revenue, smallest as well, 150 billion compared to the 200 and 300 billions of the other companies. Revenue growth rate, though, is the highest, 19.24%. EBITDA lowest again, and net income lowest again. Profit margins, only Microsoft beat them in profit margins. Meta with 34.49%. Price to sales, price to book, it's on the lower side as well. And PEG, which is the Peter Lynch's formula for price earnings growth, it is the lowest with 1.1. So now EV to revenue, EV to EBITDA, and PE, what we'll do is we'll get an implied market share based on those, and we'll take an average. So EV to revenue does say it's overvalued, but the other two, EV to EBITDA and PE, says the stock is a buy with an implied share value of $574 a share, meaning the stock has still room to grow. Dividend discount model, I don't think it's going to like it. Oh, because we need, I said at the start of the video we're going to use this. Obviously we can't because it's only showing the current year. So next year we might be able to start using this once they grow their dividend. Finally, Ben Graham formula for intrinsic value. This was created by the father of value investing, Ben Graham. It looks at the earnings per share, the growth, the P of a non-growth company, AAA bond yield, and the current corporate bond yield, which is around about 5.12%. Analysts, as we said, expect a growth rate of Meta over the next 5 years is 13.6%. Their previous 5 years is around about 14%. So let's say if it is a buy, and no. Interesting enough, puts it similar regions of the discounted free cash flow model, which puts it at around about $400 a share. Well, close-ish. So discounted free cash flow says it's not a buy. Ben Graham formula for intrinsic value says it's not a buy, but the comparable company model comparing to Apple, Microsoft, and Google does say it is a buy. Right, guys, thanks for watching. Please check out my Patreon if you're interested. Subscribe if not already, like as well, and I'll catch you guys next time. Oh, comment what stocks you want me to do as well. I'm going to do a few backlog of these, so hopefully you're interested.